Hey guys, welcome to Binomo World. Thank you for joining us again today, this week, on the next topic that we're going to talk about, and that is the art of scaling. I'm your host Ahmed. Thank you for coming to the channel and joining us in this session today. So let's talk about this topic. How do you scale your trades? What is the meaning of scaling in trading, and how is that going to be helpful to you as a trader, whether you're a beginner or experienced trader? It's one of those things that it's a technique for you to make more trades without putting on more risk. Okay, is that even possible? So let's talk about that. The thing about trading is, when we are confident about something, we have this temptation, we have this experience. Sometimes it has happened in the past where we open trades and it becomes a profitable trade. You know, what's the natural feeling that's going to come out of that? Then the natural feeling that's going to come when you have a trade that is successful, when a trade that you make is immediately turning into a profit, what is immediately the feeling you're going to get is, I should have opened a bigger trade. I should have put on more money on that trade. Okay. So, and when that happens, what typically becomes the situation is, you will open that trade again as a second trade, and if you see that the asset continues to move in the direction that you are making, you tend to just place more trades. So adding on trades, adding a second, a third, a fourth, sometimes people put on 5 trades. And I've seen situations where in a trading competition, people would open a few small trades, and then immediately when things are going correctly, when the direction predicted is accurate, what they will do is immediately open an additional 10 or even 15 follow-on trades. So the reason they do that is because their analysis is proven correct. And the reason they do that is because if the situation proves, if the market reaction proves that whatever they are predicting is accurate, it means that their analysis is going to be valid for some time, and they don't want to find a new profit opportunity by making a new analysis. So they want to use that analysis that they have made, which is proven correct. They want to use that opportunity to make a bigger profit. So basically, the word scaling means you are simply putting on more trades. It could also mean when you put on more trades, the trade size becomes bigger and larger. And the reason for that is very straightforward. You want to make additional profit using the same analysis. Okay. It is not, it is definitely, I can tell you what scaling is. It is definitely not guessing. What they are doing when they are putting on more trades is simply making sure their analysis is valid. And for as long as that is valid, they want to make sure that they continue to profit from the same situation that they have benefited from the first trade. So, for example, I'm looking right now on the screen GBP JPY, the asset on screen. It's giving me a profitability or profit rate of 81%. So for every dollar of trade, I'm going to make 80 cents, 81 cents. And if I put in more money, if I put in a $10 trade, I'm going to be making $18 of profit from this one trade if it is accurate. Okay. So I will do my analysis carefully, and I will pick a reasonable time frame. I will start analyzing using a 1 hour or 30 minutes time frame. So let's start with 1 hour. And with the 1 hour, I can see what the current direction is for the last maybe 20, 15 candles. And that's telling me that currently GBP is going up and the yen is weaker compared to the British pound. Okay. So that trend is very clear. Now, what is also very clear if I look at this chart is, uh, as you get 4 or 5 candles pushing up, I am also getting a few candles pushing down. Okay, so that's retracement. That is natural. That is to be expected. Now, you want to scale when it is very high probability that you are going to win. Now, of course, no analysis is going to guarantee you profit 100% of the time. and no analysis is going to guarantee you that a pullback or a retracement or a short term change in direction is not going to happen. It will happen. Now, whenever retracements happen, it is a profit opportunity for you to make a bigger profit, because the asset will pull down and you get to open an uptrade. For example, in the case of GBP JPY, I get to open an uptrade at a lower price. So that lower price means that there's even more probability that if the uptrend continues, I'm going to be in immediate profit in a very short time. Okay, so that's better than opening a trade at a very high price at the peak. Okay, so if I'm seeing here, there's a few peak that we can see here. Let me draw the line so that you can see it more clearly. So, yep. So, so I'm going to use this pink. Okay. So this is a peak. Hang on, where is it? Okay. I'm not drawing. Okay, let me do this again. Yeah. Am I drawing in here? Okay. Yeah, something's up with the screen. Let me just try that again. Okay, we're back to this. Okay. Okay, there you go. There you go. Okay. Okay. So anyway, as I was saying, when you are going at the peak, which is right here, okay, the green candle, as it goes up all the way up here, it will reach a peak, or any of these candles at the top of it, that will be the current peak as you are moving. Now, how do you know you are at a very risky situation where if you open an up trade because it's going up, how do you know that you are not opening at a peak? You are not opening at a peak when there is already a pullback happening. So if I'm looking at this candle, so this is green candle 1, 2, and 3, the one right here. So this green candle is a peak because immediately before it, I don't have a red candle. Okay. Now compared to this green candle right here, this one, if you can see it. So right before it, you have two red candles. So that's a retracement happening. And this green candle is saying that there's enough buying volume that's pushing the red candle and turning into green. So a change in color of the candles, meaning that the opposite side of the trade is also happening. So when you see a red candle pulling down like this, there's a lot of selling volume. And then when you see the red candles cannot continue and it changes color to a green candle, that means the buying volume is increasing, increasingly more powerful than the selling volume. So the buyers are taking control and able to change the direction of the candle from going down to moving up. So, but this green candle is special because it's the first time the color changed from red to green. After move up, you have a long red candle, almost engulfing the green candle before it. And then you have another red candle. But this red candle has got a tail. There's a lower tail and there's an upper tail. We are interested in the lower tail. The lower tail is saying that prices went down, but buying volume pushed it all the way back up. Okay, that's how you get a tail. So that's indicating there's buying volume fighting selling volume and winning. And when the green candle is the second candle after this tail that's happening here, that is showing that the buyers are winning and being able to push the asset back up to a certain distance. Now, that's the opportunity for you to trade using a pullback. That's the opportunity where if you add your position there or you open your position there, it is lower risk than opening at any time before any of the green candles where there is no red candle before it. Okay, so this green candle is right after a retracement. Okay, so as you see the move for this candle, if you open a trade there, as it moves up, you'll get another chance at retracement, and especially the ones here where you see you have one, two, three, four red candles, a retracement of four red candles. Now, this retracement, it has even more information. What information does it have? It's pulling back, it's bringing back price down, but it's not coming back to this price level of this candle here. So that means you have a higher support than the time when you open your trade here. So if you had opened your trade here and then a pullback happens, a retracement happens, and that pullback didn't influence or didn't affect the prices here, it is stopping at a higher price. So that is what we call higher support. And then from higher support, you get another change in candle color. So you get this red candle changing into green, and then this green candle is pretty tall. It went all the way up, overcoming one, two, three. It's overcoming almost three red candles. In one green candle, it's overcoming almost three red candles. So that is a very good sign for a trend that's going up. A color change in the candle from red to green, and then the size of the candle is huge enough to cover more than one red candle. It's a very positive sign for an uptrend. And that's your second opportunity to open a trade. Okay. So if you had opened a trade here and you're thinking the analysis is correct because the asset is continuing to go up in the direction that you predicted based on your analysis, you are looking for more evidence that your analysis is correct. Now, of course, for as long as the asset is going up, your analysis is correct, but the probability of you winning in the next trade is higher when there is another pullback and then a change in candle color. Okay, so consider the situation where the asset is continuing to go up and you don't wait for a retracement. So let's say you are here, you don't wait for a retracement, you open a trade here. Now, when you open a trade here, this probability of you winning compared to you opening a trade here, the probability of winning in this candle and this candle is different because this candle is after a pullback and this candle is before a pullback. So you don't know if the pullback is going to happen when, and if it happens, you don't know how far down it's going to pull the price down. Okay, you don't know how far down. So imagine a major pullback, you know, going down maybe five or six candles. So you've lost that opportunity to win bigger from from that move down and then a change in color. So this candle has more certainty to it. If you open this candle here, now that we know, we are looking back, we are back testing. Of course, you're saying that if we open this candle here, it eventually will go up. Yeah, but we don't know the situation that this is going to unfold. We don't know that's going to happen. Now, so it is better for you to open a trade with higher probability, the highest probability you can find, and that will be the candle right after the pullback. Okay, right after the retracement. So that's what's happening here. And if you open somewhere here at the middle or the near the top of near the top of this green candle after the retracement, that has a high probability of going up. Okay, so we are on the 1 hour time frame. So there's a lot of time for you to make money with GBPJPY because this candle after the retracement, it's taking its own sweet time to go up, and it's not even challenging the middle of this candle. The candle where you open your trade, it's not even going down, retracing back to the middle price of that candle, meaning that it's a certain win that continues. So all these other candles, the opening prices are even further higher. So that's a really good situation to be in. So if you wanted to scale, you will definitely want to scale when the trend is strong and the trend is consistent. But you don't scale on the first trade. A lot of traders who are confident with their trading strategy, a lot of traders who are who've enjoyed one or two winning trades at the beginning of the day, what tends to happen is they become slightly overconfident. And when that happens, they think they cannot make a mistake. And when they think they cannot make a mistake, what tends to happen is their first trade will be bigger than what they normally would do. So if they normally make a trade of $10 size, okay, one trade, the size of their trade would normally be $10. Then what they do is when they're confident, their next trade, which is the first trade, new asset based on a new analysis, they'll open a $20 trade or a $30 trade. That's very risky because that new trade based on a new analysis has not yet been proven, has not yet been tested. Of course, the trader would say, I'm using the same strategy, I'm using the same analysis. But remember, the previous win doesn't explain the chances of you winning in the next trade and finding the next win. It's totally independent. Every trade you make has its own set of probability that is not influenced by the previous trades. Okay, the previous trade could be luck, it could be because of your strategy, but there's no way to tell until you close the trade. So the safer way when you intend to make more profits from the same analysis on the market is not to open one big trade at the beginning, but rather open one small trade at the start, and then as the trend progresses and continues to move in the direction that you analyzed and predicted to be correct, then you open follow-on trades. And when you open follow-on trades, this is scaling. This is called scaling. When you open the second trade, when you open the third trade, when you open the fifth and sixth, trade number five, trade number six, that's scaling in. And you scale in when you have a high probability setup. The high probability setup, like we discussed, is when a retracement happens and then you get another change in color change for your candlestick to move in the direction of your analysis. When that happens, you open your second trade. When that happens again, you open your third trade and fourth trade, and so on. So that is lower risk compared to opening one huge trade at the beginning. Because if you make a mistake on that, you lose everything. Whereas if you open different trades as the trade progresses, by the time you open your second and third trade, you would have closed your first and second trade. Okay, because the duration is the same, but it wouldn't depend on the other trades. So your first trade would close first, your second trade would close first, compared to your third, fourth, fifth, and so on, all the other trades. So if you make a mistake at the end, let's say you open a total of 7 trades. If you make a mistake at the end, what will happen is the way you manage the risk is all the trades you're making are not based on the same price level. So your if it changes direction at the end and the market proves that you're wrong at the end, you would probably lose your trade number 6 and number 7, but you still get the chance to make profits on your trades number 1, 2, 3, 4, and 5. So that's far better than opening one huge trade. Let's say you close one trade, uh, you close the first 2 trades and you make profit out of it, and then now you want to scale in your third and fourth trade. What you do is rather than open 7 trades of the same size, you open the third trade with a bigger size, and the fourth trade with a bigger size, the fifth trade with a bigger size. Now imagine the market changes when you are on your fifth trade. So what will happen is because the fifth trade is a bigger size than the first trade, that loss from the fifth trade will take out the profits you made from your first and second trade because you increase the size of trade number 5. The losses there will be bigger. When you increase the size of the trade, the losses will be bigger, and that's gonna eat up the profits you make in your first and second trade, and you don't want that to happen anytime, okay? So the way you scale properly is you add trades evenly over time, and when I say evenly, the size will be the same every time, okay? So 1, 2, or 3 losses at the end will not wipe out all the profits you made at the beginning from all your earlier trades, okay? So bear that in mind. I'm just looking at the screen here. We've got some chats coming in. KRJ Satik, hi. If I can see your question right here. Yeah. What's the difference between crypto and OTC? So OTC, the volume is different. The crypto asset is the asset that tracks the real crypto. So whenever you see OTC, that means the asset is not yet trading full volume. So when assets are not trading at full volume, the trends that you see or the movements that you see based on the candles are affected by low liquidity or thin volume. Sometimes it can be jerky, sometimes the spread could be high. So that's what OTC is. Basically, it's not trading at full volume, um, and you get that jerky movement, and prices are not the best. So if you're trading something, an asset that doesn't have OTC behind it in its name, then that asset has full volume. Like right now, if you see on my screen, gold doesn't have OTC behind it. So if you're trading gold right now, that will be full volume. It'll be tracking the real market. It's not OTC. OTC stands for over the counter, and that happens when the market is not full volume. AUDJPY. You see AUDJPY right here. I'm putting it on the screen. The OTC here. So AUDJPY on the platform right now is trading at full volume. So, but of course, you gotta be mindful what time you're trading. If you're trading right now, we are trading the Asian session. In the next 3 hours, London market is going to open. So that's gonna bring in more volume when London market opens. When we are trading in the London market opens, you're getting volume from the European traders. European traders will come in. They will also add to the AUD volume, and you have more market participants. So the more traders coming into the market and trading assets, you get prices reflecting far more accurately, and sudden movements by some players is not going to immediately change the direction of the asset because there's a lot of volume. Okay, when you're trading in thin volume situations, when you're trading in OTC situations, or when you're trading early hours in the Asian session, sometimes even middle-sized players they put in a huge order. It could affect or change the color of the candle. So if you wanted to not be affected by situations of thin volume, wait for the London market to open because you will have a bigger volume. Or if you want to have the biggest volume, wait for the New York session to open, which is going to be about 5, 8, 6. Yeah, but it's going to be about 6 hours from now. 6, 7 hours from now, New York session will open. Okay, so that's how you read the volume for that's what OTC is telling you basically. And let me see if we have another question. Yeah, yeah. So thank you for joining us, KRJ Satik. Feel free to share the video with your friends. Get them to subscribe to the channel so that they can participate and join us in discussions talking about trading psychology, talking about assets, talking about trading techniques. And when you go into the chat and engage in discussions, you'll learn from other traders as well. That's going to be very, very useful. And let's see what we have here. We have more questions coming from. Feel free to ask any questions at all. If you need me to cover a specific asset, I can also do that whilst we are talking about scaling in and out of trades. So scaling in is when you add positions when you are confident with the trend that you are analyzing and you add more positions to it. That is scaling in. Scaling out in the context of the Binomo platform is when you become less confident about the trend because the trend has gone on for so long. Let's say the trend is something that you predicted will last for the next 2 hours. Okay, let's say you predicted something that will last 2 hours. So scaling out means you are reducing your risk on your later trades that nearing the end of the trade where you think the trend is going to expire after 2 hours. So the way you scale out on the Binomo platform is those last few trades that you open, it'll be smaller than your earlier trades. You open smaller trade sizes so that if you get it wrong, your risk and your losses will be very small, and it won't eat any of your profits from the earlier trades that you've made. Okay, so it's really, really useful. Going in, scaling is useful for you to go in and make more profits. It is also useful for you to make additional profits at the end, but also at the same time protecting yourself from huge losses. So definitely do not increase the size of your later trades, but reduce the size if you wanted to scale out, if you wanted to reduce the risk of your trades at the end. Okay, so be careful of that. Trends do not last forever, especially when we're talking about forex assets, especially when we talk about um especially when we talk about forex assets. It will tend to move in up direction and then change direction and come back down. Even though it's an up trade, it will, at the end of the day or at the end of a cycle, it will come back down before it continues back up. Now, you don't know how far that comeback down or that retracement is going to result in a total change of trend. So always be mindful that when you see a trend that is valid on your trading strategy, remember that it's not going to go on forever. So set a time limit, set a 1 hour or 2 hour, predict based on the historical candle size. So if I'm looking at this asset here, I'm looking at AUDJPY. I'll do a 30 minutes time frame analysis on it. Okay, so it's not going to continue forever. So if you look at this asset is going up. Okay, and then it comes back down, and it stays in this range for quite some time. Stays in this flat range for quite some time, and then it goes back up. And then if you thought that this upward movement is going to go on forever, look at what happened next. It went back all the way down, even lower than the tall green candle here. The three red candles here pushed prices so low, so it went from 99.127, this level up here at the top, and it went all the way down to 98.93. So be mindful in forex assets, it won't go in one direction. So if there is a trend that is going up, tell yourself to get out after a certain time. Look at the trend of the asset. Does the trend of the asset show that it tends to pull back after 5 candles, after 6 candles? Then you need to be careful about the trade duration so that you know by the time it reaches the 6 candle, you didn't just open a big trade, or you didn't just open a long duration trade. Okay, be mindful of that. And then it happened again. So from here, from 98.95, it pushed all the way up to 99.23 AUDJPY. And then when it came down all the way. So you'd have lost everything, if you tried to scale in and open so many trades here. Let's say you open 3 or 4 trades on the way up, you could have lost all that money from your earlier trades if you had set a long duration. So keep short durations and be mindful that things can change direction at any point in time, for especially for forex pairs. If you're talking about stocks, it's different. Leading stocks tend to go all the way up. If it was Microsoft or it was Apple or something like that. So be mindful. So that's what I have for you today, talking about scaling in. Thank you for joining us. Be sure to subscribe to the channel, and we're going to see you next time. Take care.